How's it going, guys? There's been a lot of talk about another housing crash, but will it be a crash or a correction? Let's take a look at the sales prices all the way back to the 60s by decade and do a bit of analysis to understand what the housing market could potentially do. So this data is directly from the St. Louis Fed. What we'll take a look at is appreciation of the median sales home price since the 60s. While this data may not be perfect, it'll help us start to get our arms around what could potentially happen over the next couple of years in the nation and in Cedar Rapids. It goes all the way back to 1963. And if we look all the way from 63 to 70, we can see that the median sales price for houses sold in the United States went from $18,000 all the way up to almost $26,000. So it's a total appreciation of about 46% over the course of that decade. We take a look at the 70s, we see a much bigger jump from around $21,000 all the way up to about $65,000, almost 200%. That's quite a substantial jump. Now remember, in the 80s, there was substantial inflation, and so you would expect to see that drop. We do see a bit of a drop around the end of 81 into 82, but there was still substantial growth over the course of that decade. Now, this is where we start to see things slow off a little bit. In the 90s, it was about 40%, and in the 2000s, even with the quote-unquote crash in 2008, prices still appreciated 37% over the decade. And then in the 2010s, we see another 54% increase. So you see 70s and 80s, substantial growth. 90s, even 2000s, through the housing crash in 2010s, over a course of a decade, we still see pretty significant growth. And then this brings us to the 2020s. So this is only 2 years. We see 30% appreciation from early 2020 to Q1 of 2022. If we go back to 2010 and just append the last 2 years on, we can see that significant growth. So if we're just looking at 2020, it doesn't look that substantial, but it's a much shorter period of time. So we do see pretty significant growth in the beginning of the 2020s through where we're at today. You know, if we aggregate all of that data and look at it, the green line from left to right is the high price. Darker orange line just below the green line there is the low price. You can see a pretty nice trend over time where they continue to grow even through the 2008 housing crash. That lighter orange line is the percent of change year over year. So you remember, in the 70s it was almost 200%, in the 80s is about 100%, and then kind of starts to taper off a little bit. So one of the common misconceptions, or one of the common things that we hear a lot, is that home prices are just unsustainable. They're rising way too fast. The thing to keep in mind is they're maybe rising what looks like a little bit faster in terms of absolute value, but as a percentage of change, it's less. They're actually not rising as fast comparatively as to what they feel like. While you may see prices jump from $250 to $300, that's less of a jump than when house prices went from $100 to $150. So what does this mean for Iowa? The other thing that I hear a lot is that a small market like Cedar Rapids must crash a lot harder than the rest of the United States because it's a smaller market. Well, actually, this data shows us the opposite, and we kind of know that. We know that Iowa and the Midwest is always typically a little bit insulated from what happens in the rest of the United States, and specifically on the coasts. What this data shows, and again, this is aggregated off of Zillow Home Value Index, so probably not the most accurate, but at least it's directional and starts to help provide some understanding of where things might go. The graph on the left with the purple and the orange is all of the United States. The thick black line is the average change since 96. So if we separate Iowa out of that and look at the graph on the right, these couple of orange lines are the metro areas in Iowa, places like Des Moines, Cedar Rapids, Davenport, so on and so forth. And so we see that typically the Iowa metro areas are performing worse than the national average and less volatile. So if we look at peak to trough of the national compared to Iowa, we see that through the housing market correction in 2008, we see that the national average came down about 50% from peak to trough, and since it's gone up another 175%. Well, if we look on the other graph to the right, we see that Cedar Rapids singled out. You see that orange line is much less volatile than the big swings of the United States. So in Iowa, 2008 to 2010 was actually pretty steady. There wasn't a lot of decline in Iowa. It was only after the nation had started to fall dramatically that Iowa fell. But then Cedar Rapids only fell by about 16%, whereas the rest of the United States fell by 50%. So much less of an impact than the United States. And then we see that on the other side as well. When it goes back up, it doesn't go back up 172%. It goes back up about 90%. So again, a little bit less dramatic than what the United States is doing. The other thing that I think is interesting here, Iowa seems to be insulated, and specifically Cedar Rapids, even in duration. It was about 10 years from high point in 2007 until it reached that point again in 2017 for the United States. It was only about 4 years for Iowa to rebound. The correction was substantially less, and the duration was substantially shorter than that of the United States. I just really want to center on these things to say there's a lot of speculation out there. There's a lot of fear that house prices have been growing too far, too fast, and we're going to see another massive crash. We are likely to see another correction. Even in 2008, that correction was about 20%. House prices appreciated overall through the decade. And we can see from this data, Iowa, and particularly Cedar Rapids, doesn't experience as dramatic of a change or as much volatility as the rest of the United States, and the duration is shorter. So if your fear is that housing prices are going to crash, or you're waiting to buy, the correction may not be as dramatic as people think that it will be, given historical performance through another similar correction. The other thing to keep in mind is available inventory is also substantially low. So while rates continue to go up, inventory remains an issue. New home starts have declined month over month, some of them to the tune of 40%. So that means while rates go up, the inventory issue may not be solved, which sustains higher home prices. Again, if you're thinking there's a huge crash coming, if you're thinking I can wait to buy and buy houses at 20, 30, 40, 50% of what they're going for now because of a correction, and so the higher rate won't hurt me, that may not be the case. Now, we don't have a crystal ball. We can't say for certain what's going to happen, but we can look in the past and see directionally where things might be going. Certainly, I would advise everyone's situation is different. Do what's right for you and your family. But I wanted to take a minute and go through the data to hopefully help provide you with a more informed perspective about where things may be headed. Thanks for watching. I'll see you guys next time.